Good afternoon. This is a presentation entitled What is New and Exciting in the Land of the Liquidator. Suffice to say, I brought you here on false pretenses. If I told you the presentation that I'm about to give you was complex, difficult and possibly even arduous, I'm pretty sure you wouldn't listen to it. But I do think it's things that you will actually need to know to advise clients properly going forward. Given there's some technical issues that we will discuss, I do need to give you the obligatory disclaimer. As I think a lot of you will be aware, there's recently been sweeping amendments to the Bankruptcy Act and the Corporations Act, which has not only made changes to the process to obtain and retain registration for insolvency practitioners. There's been wholesale changes to reporting requirements and the rights of creditors. And just when we, at least in the insolvency profession, thought it was some time for some stability, there have been a raft of further changes. So today I would like to focus on some of the areas that I think might have a meaningful impact on your clients and advice that you provide your clients when they are facing financial hurdles. So today I'd like to talk about the introduction of safe harbour, which is a concept aimed at protecting directors from personal liability from insolvent trading if the company is undertaking a restructure. We'll talk about changes to the IPSO Facto clauses, which allows contracts in certain circumstances to be terminated solely due to an insolvency event. We will touch on the one-year bankruptcy, the extension to the ATO's powers, and also some aims at Phoenix activity, or some targeting of Phoenix activity. This presentation is effectively a high-level overview of these changes. It's not aimed to be a technical interpretation. It will be a general explanation of the changes in their application and things that, as advisors, I think you should be conscious of. The origin of the first three of these changes it can be traced back to the federal government's Productivity Commission report, which was released in December 2015. That report suggested that the Australian insolvency laws were increasingly becoming out of date with trends across much of the OECD. And in particular, I think Singapore, who has certainly gone to the pointy end of restructuring culture. The government felt there was potential risk that our laws could undermine innovation in the Australian economy. Now, I just wanted to take you through that quote. And basically what it says is, more often than not, entrepreneurs will fail several times before they make it, and will usually learn a lot in the process. To help these entrepreneurs to succeed will require a cultural shift. We need to encourage Australians to take a risk, leave behind the fear of failure, and be more innovative and ambitious. Concerns over inadvertent breaches of insolvent trading laws are frequently cited as a reason early-stage investors are reluctant to get involved in a startup. Our current insolvency laws put too much focus on penalising and stigmatising the failure. So we're making some changes to these laws. Now, when you reflect on that quote, I think there's a couple of things that come out of it for me. One is education. To me, wouldn't it be better to educate directors in this sphere rather than the alternative, which is have a couple of goes and see how you go, and we will give you more ability to fail. The government's intention was to force a cultural shift away from stigma. So let's have a look at some of these changes in a bit more detail. First of all, we'll look at safe harbour. I'm sure you've read about it, and in September 2017, the Commonwealth Parliament passed the Treasury Laws Amendments Act, One of the main changes was the introduction of safe harbour protection for company directors. Now, at their simplest, they provide directors with protection from potential liability for insolvent trading in certain circumstances. And that is broadly where directors have begun developing a course of action that is reasonably likely to lead to a better outcome than the immediate appointment of an external administrator. Safe harbour is intended to give the directors breathing space to take reasonable, considered risks to restructure or turn around viable companies. And that's without necessarily exposing the directors to the risks of insolvent trading. Now, that's the theory in any event. Let's have a look at a quote from the former Minister for Small Business, the Honourable Michael McCormack, which you can read on the screen. The connotation in this quote is the fear is so great that directors quickly jump in to put a company into the hands of an insolvency practitioner at the slightest hint of trouble. Now, I work a lot in the SME space, as we all do at Worrells, and I'm not sure that that is necessarily true of directors in the SME space. It may be true for directors of large companies with professional directors who themselves don't have a large vested interest in the business or are fearful of putting their own assets or their own reputation at risk by allowing a company to trade whilst insolvent. Now, to have a look at what safe harbour is aimed at protecting, we really need to revisit what insolvent trading is and therefore what the legislation is aimed at protecting. So let's have a look at insolvent trading. Broadly, if we look at it in layman's terms, if you're a director of a company at a time when the company is insolvent and then incurs a debt, there are reasonable grounds for suspecting the company is insolvent. As a director, you can be held to be in breach of the insolvent trading provisions. Simply put, the company is in serious trouble, shouldn't be trading, and if you as a director decide to ignore the warning signs and keep racking up debts, you do so at your own peril. There are obviously significant penalties and sanctions if you are in breach of the insolvent trading provisions. Firstly, there could be civil penalties up to $200,000. And if you're a director of a company, you could be at risk of these sanctions. Secondly, potential liability to compensate the company for the amount of debt that has been incurred subsequent to the company becoming insolvent. And there's potential criminal prosecution. That's basically where there is dishonest and intentional insolvent trading. So there's a higher bar in particular for that particular element. Now let's have a look at a simplistic example. We'll have a look at a builder. Obviously, working a lot in the SME space, we tend to do quite a bit of work with builders. Now, in this simplistic example, we have a customer, I'll start firstly with the company, which is trading well up until the 30th of June 2018. We then have a customer that goes into liquidation on the 1st of July 2018. And when the customer goes into liquidation, that customer comprised 99% of the debtors ledger of the company, and it became unrecoverable as soon as that customer went into liquidation. So there's no prospect of future revenue, and there is no prospect of recovering what was due from that customer. The company, despite this, makes a new order of stock in August 2018 and incurs a $50,000 debt, despite the fact that at the time we lost the major customer, the company has become insolvent. So unfortunately, the builder finishes up in liquidation in November 2018. As you can see, a $50,000 debt has been incurred after the company has become insolvent. The test of whether or not a company is solvent or not is, can the company pay its debts as and when they fall due? The loss of the main customer had meant that this client could no longer pay its debts as and when they fall due. As a result, there is a potential $50,000 claim against the directors for allowing the company to trade whilst it's insolvent. This is a simplistic example, but it basically highlights how insolvent trading works. Now, it's not all bad news for a director of a company. There are defences to the insolvent trading provisions. The defences are the director has reasonable grounds to expect that the company was solvent. The director didn't participate in the management of the company, and at the time the debt was incurred, and that must be for good reason, or where the director took reasonable steps to prevent the company from incurring the debts. If none of these defences apply and insolvent trading has occurred, there could be some exposure for directors. And you need to remember these provisions are aimed at ensuring a director considers when it's time to stop trading and stop incurring debts that the company has no ability to repay. Because if you think about it, if we didn't have these provisions, then there would be no prohibition in allowing a company to keep trading and keep racking up debts when there is just no prospect whatsoever of them ever being repaid. So is insolvent trading really that scary? Some directors, certainly in the SME space, take the insolvent trading threat very seriously, and they're concerned about losing the family home or going to jail. In fact, last week or the week before, I saw a director, and one of the first questions he asked me is, am I going to jail? Because he was concerned that the company may have been trading whilst insolvent. On the other hand, you do see directors who don't see insolvent trading as an issue at all, and they tend to completely discount insolvent trading. And if I had to get myself into the psyche of a director in the SME space, thinking about it logically, often they've poured everything they own into the business. They're more concerned about personal guarantees they've given. They're more concerned about the bank security over the family home to support the company's borrowing. There are far more immediate risks to them than what they see as a potential risk of insolvent trading down the track. That would be my best guess of the psyche of a company director in the SME space. What is the reality of an insolvent trading claim? There are some difficulties from a liquidator's point of view. Solvency and determining solvency is the first one. Determining when the company became insolvent is not easy. It's time consuming, and it depends on the books and records of the company. I was reflecting when I first started looking at this presentation as to the quality of books and records that are provided by directors of companies. I've been doing this work for many, many years, and I was able to remember getting a very good set of records once. And that company was actually a timber merchant, and they were able to tell me where any stick of timber was sold on any particular day. Their records were immaculate. I think they were probably the best set of records I've ever seen of a company in liquidation. The only problem is, I think it was those records that actually caused the demise of the company. Because when I was appointed liquidator, there was actually one salesperson and 6 people in the accounts office. So yes, from time to time we do see a good set of records, but more often than not, we see incomplete records. Sometimes I'd go as far as saying terrible records for companies that are in that subsequently go into liquidation. So determining solvency is not easy, particularly when you've got incomplete records. The other thing is, if you have a full-blown trial for an insolvent trading claim and expert evidence on the date of insolvency comes into question, it wouldn't be unusual to have 2 experts who have 2 very differing views on the date the company became insolvent. The other thing to bear in mind with an insolvent trading claim is often, particularly in the SME space, directors' wealth is intrinsically tied to the success of the company. So there may be a very good claim for insolvent trading, but action is futile if there's no real prospect of recovery from the directors. And as I said, it's not unusual to see directors who have poured absolutely everything into a company. The costs of pursuing an insolvent trading claim can be high. I was reflecting on this in preparation for this presentation, and I took over a number of files from a former liquidator some years ago. In amongst those claims was, or in amongst those files, I should say, was a file that had an insolvent trading claim. Now, when I picked up the file, I thought, oh, this will be interesting. There's been an insolvent trading claim instituted against the director. And what I found was that claim was for $14,000, so it wasn't a particularly large claim. The costs when I picked up the file were 4 times that. So there was no prospect of any surplus going out to creditors. The other thing is you need to do a cost-benefit analysis, and that flows from the last point. When you look back at the claim that we had in the builder example, it may not be worth chasing a claim for $50,000 because at the end of the day, it might cost $50,000 to bring that claim. So again, as a liquidator, you really do need to be running a cost-benefit analysis. And don't forget, a creditor can run an insolvent trading claim. So it's not just open to a liquidator. A creditor can also do so with the consent of the liquidator. So let's have a look at some statistics. Now, these statistics are a little bit aged, and they are from a Melbourne University study between the years of 1990 and 2004, so 14 years. And in that time, there were 100,000 liquidations. Now, the Melbourne Uni study finds that there were 77 judgments in that time, so very small proportion. This doesn't tell you how many demands were issued, how many matters settled along the way. These are purely judgments, but as you can see, the number is quite small in comparison with the number of liquidations that happened in that period of time. Let's have a little look at some of the further statistics that come out of that study. Of the judgment, 75% of directors were found to be liable for insolvent trading. So it was quite a substantial portion of directors at the end of the day. And the largest judgment was for $96.7 million. Now, some of you will be aware of this particular case. It was the case of the National Safety Council, where John Friedrich was involved in, I think, what could be best described as a financing fraud. Ultimately, there were assets that weren't around when the liquidators came knocking. So there were significant assets that had been financed over a number of times, assets that didn't exist. So that particular amount, $96.7 million, that's a lot of money today, let alone in 1990-91 when that trial was on. So that was quite a significant amount of money. The smallest judgment was for $520, and that certainly makes my $14,000 example that I told you about a little bit earlier pale into insignificance. The median figure of all of these judgments was just over $110,000. Now, when you consider this was between 1990 and 2004, $110,500 was still a fair bit of money. So hopefully that gives you some background on insolvent trading and paints a picture that it is actually a very live issue for directors of all corporate entities and something for the directors to be aware and conscious of. So let's now go back to safe harbour. And in basic terms, what the new provisions do is carve out the insolvent trading laws where the directors are working to find a better solution than external administration might offer. So simply put, if as a director you have safe harbour protection, the insolvent trading provisions don't apply, but you actually need to qualify to gain this protection, and to maintain the protection, there's not only the qualifying criteria, but there's also other matters that you need to attend to as a director going forward. So what I'd like to do is walk you through the legislation shortly, but with any new legislation, there's likely to be unexpected implications and ambiguities. It's not yet been tested in court, and there's still uncertainty as to how some parts of this will apply. The legislation has been in place since September last year. So let's have a look at the thresholds. The thresholds, and there's two thresholds to be established. One, that employee entitlements are paid when they fall due. And second, the company's complying with its reporting obligations to the ATO. This particular piece of legislation is not available if there's been less than substantial compliance, or if there's been 2 or more instances of non-compliance in the preceding 12 months. Now, as I said earlier, I spent a lot of my time in the SME space, and many SMEs fail to keep their books up to date when they're approaching insolvency. They really struggle with tax compliance, and often they don't pay super when it's due. So it might actually be quite difficult for SMEs to get past the threshold. The explanatory memorandum talks about these laws being available to competent directors and those acting honestly and diligently. But what about the company with an atrocious track record who brings all of their lodgements up to date with the view to trying to get safe harbour protection? And I should say that this only requires tax lodgements to be up to date. Tax payments don't need to be up to date. As if you think about it, if the law required all tax payments to have been made, it would have given the Commissioner of Taxation a preference over other creditors. The other thing I question is the ability of SME clients approaching insolvency to ensure their super is paid, whether it is enough to lodge superannuation guarantee surcharge statements. All of that, I'm sure, will be clarified in due course. So I do think that it's probably going to be a bar that is actually too high for many struggling SMEs to actually meet those 2 thresholds. So what about the ongoing criteria? There is effectively the need to ensure that the directors start developing 1 or more courses of action that are reasonably likely to lead to a better outcome for the company than the immediate appointment of an external administrator. So the ongoing criteria only becomes relevant if you're confident that you've got a client who meets the thresholds that we talked about earlier. So if your client does meet the threshold and they start developing the plan, then any debt that's incurred directly or indirectly in connection with any such course of action, they're likely to have protection from an insolvent trading point of view. Now, there's a few things to bear in mind. Starts developing is important because it implies to me that the directors have some time to actually develop the plan. I don't think it needs to be immediate, but I think it needs to be certainly followed through fairly quickly. Protection will cease if a person fails to take a course of action within a reasonable period of time. However, if the person commences taking the course of action that's reasonably likely to lead to a better outcome for the company, then they will get protection. And protection continues until such time as either they stop taking the course of action or it's no longer likely to lead to a better outcome. So that brings us to a really interesting question, which is what is a better outcome? you'd be very surprised, I'm sure, to know that the legislation is silent on what is a better outcome. The commentators are saying that it's a cents in the dollar return of an immediate insolvency versus the proposed course of action. Now, that calculation of the cents in the dollar return is something that we at Worrells do day in, day out. So we can help you or your clients with those calculations if you require it. And it might require a consideration of other stakeholders, including employees and shareholders. So bear that in mind. It is a calculation that we can help you with. And in due course, I suspect that liquidators are likely to bring the better outcome test before the courts for guidance. So I think we will see some litigation in this space. So let's have a look at some of the things that I think might be better outcomes. It might be that where the business is seeking a buyer or investor for the business, might actually bring about a better outcome than the immediate appointment of an external administrator. So that might be one thought as to when you would be able to use the safe harbour provisions. When the company is implementing a cost-cutting plan. Now, I would like $1 for every director of a small company that I've had in that has suggested to me that they could actually save some money going forward and that their expenses in the past have been high. Problem is we need to work out whether it is actually likely to bring about a better outcome. So it's not out of the question, but you need to look at it objectively. If you've got a company that's seeking to refinance, again, that might be enough to bring about a better outcome. And lastly, seeing through a pending transaction that would have the effect of improving but not curing the financial position. And the one that immediately comes to mind for me here is the construction company that might be finishing a large contract and there is a very large payment due at the end, or alternatively getting it to the next contribution from the party that they are contracted to. So again, that might actually bring about a better outcome than the immediate appointment of an external administrator. So the process as far as safe harbour, we'll have a little bit of a look at it, but the legislation is abundantly clear that it is irrelevant if the plan actually leads to a better outcome. So that doesn't actually matter, that it doesn't actually lead to a better outcome, but on the face of it, it has to look like it's going to be a better outcome when the company enters into it. The legislation points to a number of factors that can be considered in determining whether a course of action was reasonably likely to lead to a better outcome. And the first one of those is advice being sought from an appropriately qualified entity who was actually given sufficient information to give appropriate advice. Now, again, appropriately qualified entity is not defined. My personal thought on that is that you are looking at accountants, lawyers, insolvency practitioners who are likely to be appropriately qualified entities. Directors need to be careful. This is not a set and forget strategy. The turnaround strategy must be carefully and continuously monitored and documented. And I think certainly in the SME space, most SMEs really struggle to document things. I think this is really where you can help your clients get these things documented. But it's really important that they carefully monitor and continuously monitor any plan. As I said, it's got to look like it's likely to lead to a better outcome. And if it doesn't, then they either need to develop and implement a new strategy or immediately appoint an external administrator. So monitoring the plan does become crucial. So let me take you through a very simple example. It's the example of the wine bar. Now, I've often said to people, when I retire from the insolvency profession, what I would like to do is run a wine bar. I like one, and I figure I could probably work, between 6 and 9 months of the year. The other 3 to 6 months, I probably need to do a fair bit of travel to source my stock. You'll find me possibly in Europe, you might find me anywhere actually looking for stock. But anyway, back to reality. We've got a client who comes to see you who, his name is John, and he's been running a wine bar. And we'll just have a look at whether or not the safe harbour provisions could apply to John and his wine bar. John, up until now, has always been on time with his employee payments and his tax lodgements. The business was doing fine up until the fact that he's discovered a stock problem, and he's only discovered it last week. And he's also got fairly low cash reserves because he's just coming through winter. So his stock levels are quite low, and as are his cash levels, and his creditors are pushed out. So ultimately, he's concerned that company may be insolvent or might be likely to become insolvent in the not too distant future. And he comes to see you to get some advice on whether or not he can actually use the safe harbour provisions. We have a look at it, and ultimately, John's optimistic about the future. He says, yep, look, I think I can return this company to profitability once I get over this stock issue that I wasn't aware of. So he seeks advice from his accountant, a logistics manager, and a liquidator to work out what the numbers were likely to be on the immediate appointment of an external administrator. And I have to say I've sold quite a bit of alcohol recently in quite a few jobs, and ultimately they don't return particularly good amounts of money. So therefore, he wants to implement the safe harbour provisions, and on the face of it, he could implement them and could actually run with it. He needs to continuously monitor the plan, make sure it's well documented, and all going well, would then pay creditors back over a period of time. So there are a couple of other matters I think are worth noting. Anyone who actually uses the safe harbour provisions is required to prove their actions were reasonable. The evidentiary burden will fall upon the person that is seeking to use them. Interestingly, there's specific legislative provisions that if a company goes into external administration and the directors don't cooperate, you actually lose the protection of safe harbour. And there are a number of forms that have got to be actually lodged with the liquidator, that if your client has after using safe harbour doesn't do that, they put their head in the sand, then they actually lose the safe harbour protection altogether. And the third one is directors will only get protection from insolvent trading. They're still liable for all other directors' duties. So I think it's important to bear those matters in mind. So what about safe harbour in the SME space? My view is that some directors will see the concept of safe harbour as an overall panacea to all of their issues, and certainly all of their financial issues. I think SMEs are likely to not have the access to funds to get good advice as opposed to a large company. And it's usually the SMEs that have more skin in the game, in that they have, as I said earlier, probably put everything into the company to keep it going. And they're more likely to take risks, both good and bad, when faced with insolvency. That is probably a little problematic for safe harbour provisions. And the other thing is, as I've already mentioned today, the directors probably have exposure to the things that you see on the screen: personal guarantees, security by banks over real property, directors' loan accounts, ATO director penalty notices. So it may be difficult for them to use these provisions. And I think they're more likely to be concerned about those provisions than looking at the safe harbour provisions. So I'm not sure how much take-up there is actually going to be around safe harbour in the SME space, but I guess time will tell. And I don't want you to forget that there is an alternative to safe harbour. So if you've got a client who's in financial trouble, a deed of company arrangement might be appropriate, in that a deed of company arrangement can protect a director from an insolvent trading claim which could be brought by a liquidator. So it's quite important to remember that. I'll run you through an example. The example is of Bob's Bakery. Now, Bob has been running 2 bakeries, and the bakeries are turning over about $2 million per annum. Bob's company had historically made a profit of between $150,000 and $250,000 per annum. Bob unfortunately loses focus, and he actually has a marriage breakup, gets remarried, he spends a lot of time travelling, and he takes his eye off the ball. Not an unusual story from the sort of insolvent companies that I see from time to time. Bob puts trust in his 2 sons, and unfortunately I've nicknamed his sons Dumb and Dumber because ultimately these 2 aren't particularly good at running the business. They're particularly bad. So when Bob comes back from overseas, he realises the company's been trading at a loss, and that the cash has been depleted, and that he's got a couple of creditors that total about $300,000. So Bob is confident now that he's back on deck that the business can be turned around. So if you had a client in Bob's situation, what would you do? Ultimately, I think he's probably got 2 options. One, he could look at something like safe harbour. Now, safe harbour, maybe the company's eligible, maybe it's not, because do you think Dumb and Dumber have lodged the BAS statements for the last couple of years? Do you think all of the tax returns are up to date? No, they didn't bother with any of that. So perhaps safe harbour is in fact not an option for him. The other option is voluntary administration and deed of company arrangement. And I suppose if we look at it from the point of view of if safe harbour was available, then Bob needs to make sufficient money to repay all those creditors. So that's probably a 3-year process when you look at it. Historically making $150,000 a year, we've got creditors of 300. It's going to take at least 2 to 3 years with no problems to actually turn that around. The other option is voluntary administration and deed of company arrangement. And that option, I think, is potentially a good one. It might be that Bob considers making the profits from the company for the next 12 or 18 months available to creditors. So he wouldn't be paying creditors in full as he would in safe harbour, but ultimately he'd be making a contribution to the creditors to pay a number of cents in the dollar to them. The voluntary administration process is a formal process which probably provides some more certainty. And I guess the other thing we should just reflect on is the purpose, and this is the statutory purpose of voluntary administration. It's important to remember that, and it is certainly a good option for directors of entities who don't fit the criteria of safe harbour, or who need a different outcome to what safe harbour provisions can offer. And obviously your local wealth partner can assist your clients with looking at those options. Now, I said we'd move on and talk about IPSO Facto, and I think some of the reasons voluntary administrations haven't been as successful as they could have been turn on this particular change of the IPSO Facto legislation. Now, if your Latin's a bit rusty, IPSO Facto means by the fact itself. Now, in a contract, if a specific event occurs, then it will trigger some other contractual right. So in an insolvency context, if an insolvency event occurs, the contract terminates. Builders are a classic example. Contracts terminate on the appointment of the voluntary administrator or liquidator. And I think the thing to bear in mind is ultimately cancellation of the contract is not necessarily in the creditor's interest. These clauses can lead to a destruction of value and prevent a successful turnaround of the business. And it's often why clients are reluctant to appoint us as administrators or liquidators. And when you think about it, if the company is going to lose its contracts on that appointment, you can understand why they are reluctant. So from 1st of July 2018, this has changed. The legislation actually puts a moratorium on IPSO Facto clauses, and it's a stay for when the company enters voluntary administration or managing controller appointments. It doesn't apply to a straight liquidation of a company unless that liquidation follows a voluntary administration. Now, it's quite important to note that this is only for contracts entered into after 1st of July 2018. And whilst it applies to insolvency-related terminations, it won't apply to terminating for other reasons. So if there's non-payment or other issues associated with the contract, it doesn't apply. As it stands, if the company enters voluntary administration, the stay on enforcement of the IPSO Facto rights continues until either the administration ends. However, if the administration ends because the company is wound up, the rights still won't be enforceable until a time when the affairs of the company are fully wound up. So, important to note, it does apply to a liquidation following an administration. There are a number of contracts that are excluded, and they're on the screen now. We really see this legislation as a real positive, as it gives a much greater opportunity for the restructure or sale of a business through the voluntary administration process. And the explanatory memorandum suggests that the intention is to breed more of a restructuring culture, which in my mind is actually a really good outcome. So let's run through an example, and this was a matter I was involved in a couple of years ago. It's a real life example of a file that we've dealt with. You can see what a different outcome the IPSO Facto changes could actually make. So this particular company was a commercial painter. We were doing both commercial work and residential work. And at the time of our appointment, they had 7 ongoing contracts for painting and maintaining the exterior of commercial buildings. And ultimately, the contract spanned many years. As you could imagine with a contract like that, first year, they were required to paint the building. So that was the year in which there was the large expense. And these contracts often went for 5 years. So in the 2nd, 3rd, 4th and 5th year, it was just necessary to maintain the exterior of the building. And often those contracted amounts were even across each of the years. So what you would see is often in the first year, they would make a loss on the contract and make great profits on the contract in subsequent years. So the company was actually paid a fixed fee. And by the time we were appointed, we were in the 2nd, 3rd year of each of these contracts. So the contracts themselves were quite profitable. The director approached us and said he wanted to put the company into voluntary administration to restructure the business. And unfortunately, each of these contracts had IPSO Facto clauses in them. So ultimately, there was an option for the client to terminate the contract on the appointment of the administrator. This company was somewhat unusual from the point of view that the company had, as I said earlier, a commercial arm to it and a residential arm. was actually largely the residential arm that had brought the company down, which is often we see the converse, to be honest. So the director approached us, wanted to put the company through a voluntary administration and possibly a deed of company arrangement. Ultimately, once we were appointed, as I said, each contract had an IPSO Facto clause in it, and despite our best endeavours to try and work with each of the parties to those contracts, they were terminated one by one. The parties to the contract weren't prepared to work through it. We had not only the option of voluntary administration, deed of company arrangement with the director, there were a number of parties who were prepared to buy those contracts from the administrator, but unfortunately, despite our best endeavours, each one was terminated. Now, you can see what a different outcome would have happened had those contracts been entered into after the 1st of July 2018, as it wouldn't be possible, or there'd actually be a moratorium on, in fact, terminating those IPSO Facto clauses. So that, I think we would have seen a very different outcome post these changes to the legislation. Now, I said we'd touch on the one-year bankruptcy. Most of you have probably heard of this initiative. It's a drive around entrepreneurship. Interestingly, the data from AFSA suggests there's 30,000 bankruptcy-type administrations per annum. Only 6,000 of these, in round numbers, are actually business bankruptcies. The ABS data suggests we have 2.17 million businesses in Australia. So it seems to me a little unusual for the government to be pushing a change to the bankruptcy duration as a means of driving business entrepreneurship. I must tell you that those statistics on the screen don't add up, purely because some debtors actually attribute both their bankruptcy to both business and non-business related issues. So that's why that doesn't add up. This matter was due to be heard before Parliament probably a week ago. We've had a change of Prime Minister in the last week, so I'm expecting it will be heard as soon as Parliament resits. And it's likely that, provided that these bills are passed, the start date's likely to be in 2019. We expect that it's going to apply to existing bankruptcies retrospectively. It's likely to come into effect 6 months after royal assent. The commentators, some are saying that it's too lenient. The authors of the bill themselves are saying there's no material impact on creditors, and they appear to justify that on the fact that the trustees' power to investigate, acquire and distribute assets remain unchanged, as do creditors' rights. You should bear in mind that those last three things on the slide, those restrictions will cease after the 1 year, so as soon as the bankruptcy is discharged, despite the fact that if your person who becomes bankrupt is required to make income contributions, they will need to make contributions for the usual 3 years of bankruptcy. I've got some doubts as to whether or not it will be that easy to actually have a bankrupt contribute in year 2 and 3 if they are income contributors. And the reason being that as the bankruptcy laws currently stand, if you've got a person that's bankrupt for 3 years and they stop making contributions after year 1, one of the ways that has been quite effective from my point of view over the years to help them in ensuring they make payment is either to threaten or to object to their discharge, thereby extending the period of bankruptcy. I usually find that a lot of bankrupts are pretty quick to make contributions if you tell them that you're going to extend their period of bankruptcy to 8 years if they don't. The issue with this legislation is that at the end of the first year after their discharge, in year 2 and 3, you don't have that threat. So unfortunately, the only thing you can do is sue and potentially make them bankrupt again. I thought it was interesting to have a little bit of a look on what we thought reducing the period of bankruptcy would likely look like on debt agreements. Now, that bottom line is actually debt agreements. And as you can see, it's only going one way. It's been going up. And there is substantial marketing done around debt agreements. And a lot of those debt agreements appear to be entered into over 3, 4, 5, 6 years. So they are long-term arrangements. I tend to see some of those debt agreements that actually fail. And ultimately, I think some of those people should have never been put into a debt agreement because they struggle to make the payments. Now, I think what we're going to see is the one-year bankruptcy laws come into place. These debtors are then tossing up, do I enter into an agreement where I repay possibly 50 cents in the dollar or more over a period of, say, 5 years? Or alternatively, do I do a one-year bankruptcy where I may have to pay some income contributions or I may not, and I'm discharged after 1 year? So my personal view is I think we will see debt agreements become less attractive when compared to a one-year bankruptcy. But I guess all we can do is watch this space. I did want to touch on changes to property transactions. Now, ultimately, all purchases of new residential premises are required to remit 1/11 of the sale price, which is payable to the purchaser direct to the ATO. Ultimately, this really is about your developers, and certainly some of the developers I see fail to remit their GST. What I do find is those developers have usually been quite diligent about lodging their BAS statements and getting their GST refunds in the early stages of the development. One, when they've bought the property. Two, when they're spending money on developing the property, and often they're getting very healthy GST refunds. I tend to find that some of them become a little bit recalcitrant as they get towards the end of the project. So once they start selling, be it unit or land, and they're ultimately needing to pay GST, often they slow down. And it's not been unusual over the years to see companies that go into liquidation, and these are development companies I'm talking about, with a lot of GST outstanding. So this piece of legislation requiring 1/11 to be paid direct to the ATO, to me it's a little bit like using a sledgehammer to crack a walnut, but I suspect it will mean much fewer developers going into liquidation from my point of view. So we'll see if that actually does transpire. Now, I also said we'd touch on Phoenix activity. This slide is really a reminder of what Phoenix activity is. Obviously, when a director strips cash and assets out before hiding them and liquidating the company, it's effectively done to deny creditors the money that's owed to them. And believe it or not, Phoenix is estimated to cost the Australian economy more than $3 billion a year, and quite a recent report suggested it's closer to $5 billion a year, so it's quite significant. Now, the government is proposing to reform the corporations and tax laws to provide regulators with additional tools to assist them to deter and disrupt illegal Phoenix activity, including introducing new Phoenix offences. These are particularly aimed at those who are facilitating illegal Phoenix activity. And certainly in Victoria, we've seen a number of raids over the last month or two on a couple of accounting practices. There's also some activity to prevent directors improperly backdating resignations. A Phoenix hotline has been set up, the number you can see on the screen. The changes to the law is also looking to restrict the ability of related creditors to actually vote on the appointment, removal or replacement of external administrators. Extension of the director penalty regime to GST, luxury car tax and WET So that would be making the directors personally liable for those matters in certain circumstances, and that one is quite large when you think potential personal liability on GST in particular, and also expand the ATO's power to retain refunds where there are outstanding tax lodgements. So there is quite a lot happening in this space. There's also new laws looking at director identification numbers to help stop Phoenix activity. And that will allow government departments to map their relationships of directors and companies through their various databases. So the government's currently consulting on these, and I guess all I can say is watch this space on these particular changes, because there is a lot happening in the Phoenix space. Another one that's probably important, particularly if you've got SME clients, is ultimately notice to credit reporting bureaus. This is the transparency of business tax debts legislation. The explanatory memorandum makes it clear it's only expected to apply to businesses with ABNs and tax debts of more than $10,000, which are at least 90 days overdue. The ATO is actually required to notify the taxpayer 21 days before making disclosure to the credit bureau. Now, if you think about it, in the current environment, it seems to me there's considerable difficulties for SMEs to raise finance. And ultimately, if you add to this the fact that there is the potential that the ATO have made a report to a credit bureau about unpaid tax debts for an SME client, I question how they will actually be able to raise finance going forward. Because my personal view is it is very hard for SMEs to raise finance in the current environment. So draft legislation in relation to the credit reporting bureaus is currently before Parliament. So today we have covered safe harbour, IPSO Facto, and the option of voluntary administration. We've looked at the potential of one-year bankruptcy, changes to Phoenix activity, and increases to the ATO's powers. If you need further information to assist a client, don't hesitate to contact your Worrells partner. Thank you very much for your time today.